Thank you everybody for joining in on this Saturday afternoon. I would just begin by saying that this is a slightly unique webinar because in most other webinars we talk about our new products, new launches. This is slightly different webinar because today we have a veteran and an expert from a top rating agency of India, which is ICRA. And I'll come to Abhishek. Abhishek, thank you so much for joining in and spending this time with us. I'll come back to you. In today's webinar, we will discuss how credit rating agencies work and look at some of the products that we have been talking about in several webinars. As you all know, all GRIPS products now, particularly GRIP X products, which are LeaseX, LoanX, InvoiceX, those products are now all those products are rated by rating agencies. In this webinar, we plan to discuss how rating agencies look at these products, how they evaluate these products, what are some of the key things that go behind a credit rating agency's desk, and what is their broader outlook on such products. So a really interesting topic of discussion, and this webinar, I hope that it will be really insightful for all of you guys. Today we have on the panel, I'll just start with Abhishek Dafria. He's Senior Vice President and Group Head of Structured Finance at ICRA. ICRA is one of the top rating agencies of India. Abhishek, I'll come back to you for a more elaborate introduction, but let me just introduce the panel. And then we have Ankit Goyal, who's the Chief Business Development Officer at GRIP. And as always, I'm Vaibhav, Chief Business Officer at GRIP, and the moderator of this discussion this evening. Just before we dive into the meat of the matter, I would just do a recap of GRIP. As in every webinar, there are new investors joining, there are existing investors. So as you all know, GRIP has been at the forefront of innovation. We are the pioneers in alternative investments. Just quick numbers, we have now done over 730 crores in investments, funded about 130 companies, and now have an active investing community of 25,000 users. As you all know, GRIP started with pioneering fractionalization and leasing models, and then basically gone on with the USP of fractionalization and diversification for individual investors. Somewhere around last year, in September to be precise, we also became the first company to launch products based on the SDI framework. SDI now, as you are all aware, is the Securitized Debt Instrument Framework framed by SEBI in 2008. Under the Securitized Debt Instrument Framework, we have now launched 4 asset classes. LeaseX was the first one. This is securitization of lease receivables. Then we went on to launch InvoiceX, which was access to invoice discounting receivables. We then securitized NBFC loan receivables and called it LoanX. And then the most recent one was BondX, which is the securitization of bond receivables. Some of you who have been active on GRIP platform and investing would appreciate this journey. Now we are opening up a large supply of different kinds of receivables, and thanks to all of you, we have seen great traction in these instruments. Just to recap, these are all regulated products, rated, and which is the topic of discussion today, and are also listed on the exchange, which and are held as demat securities in your accounts. Overall, we have done about 140 crores in these instruments now. Actually, this number might be higher as we speak. So that was a quick recap of where GRIP is. Now I'll turn to Abhishek. Abhishek, thank you again for joining in. If you could just start by your introduction, and also if you can introduce what ICRA is, some of that background, that will be a great point to start.
So thanks, Vaibhav, and thanks for having me on this panel discussing these new structured products that GRIP is been introducing to the retail investors. So just to give a brief background on ICRA first, ICRA is a well-respected rating agency in India, and it is a subsidiary of Moody's, which is one of the largest global rating agencies. And ICRA has been in this business for almost 3 decades now. Uh, the ratings which we carry out are typically for bank loans, money market instruments like bonds and commercial paper programs, and as well as securitized instruments. My journey with ICRA started in 2008, so I've been with the organization for 15 plus years. And for the last 4 years, I've been heading the structured finance vertical at ICRA. And within this vertical, we rate PTCs, SDIs, and any form of securitized debt which comes to ICRA for a rating exercise. Right, so that sort of summarizes my journey so far.
Okay. Actually, I will summarize. So ICRA is one of the top rating agencies. So ICRA is an expert, and then Abhishek, by virtue of his experience, is also an expert in evaluating performance, everything around SDI. And just for all the entire audience, we would be using some of these terms like SDI, which is securitized debt instrument, securitization. Maybe we'll also use PTC, which is a pass-through certificate, which is the underlying instrument of all GRIP products. But feel free to put in your questions if some things are not clear. Okay, Abhishek, thanks for the introduction. If you could also just elaborate on what are rating agencies? What role do they play in maybe Indian economy, capital markets, debt markets? What is the role of these rating agencies?
So, rating agencies essentially are involved in the assessment as a third party of the creditworthiness of any instrument, debt instrument, essentially. Right. So the traditional role which the rating agencies play is in assessing the entities, though the ratings that we assign are to the debt instrument issued by those entities. And very particularly in structured finance, the rating which gets assigned is to these products that Vaibhav was mentioning on the pass-through certificates or the securitized debt instruments. Rating agencies essentially, globally, if you see, have been around for a fairly long time. In India, ICRA and a couple of others have experience of now close to 3 decades as well. But internationally, the likes of Moody's and S&P have been there for more than a century or so. And the primary role which a rating agency is supposed to play is to help the investor in terms of understanding the credit risk which they are taking on themselves if they invest in the debt security issued by an organization or a trust. Right. So to whom does the rating help? Right. To begin with, the investor is someone whom we have at the forefront when we arrive at a rating decision. Because we are essentially trying to communicate to the investor where in terms of our assessment, the default probability lies on that particular instrument. It helps the investor in terms of taking a decision basis their own risk appetite as to what kind of risk they're willing to take against the returns which are being offered on that product. But other than investors, we are also playing a role in terms of helping issuers access new forms of investors. Right? So typically a company would start off by having bank loans on their balance sheet, but as they start to access capital markets, that is when rating starts to play a more important role. So investments would typically happen only in rated entities in the capital markets. So that is where a rating becomes very important from the perspective of an issuer as well. to even take it a bit further, rating agencies would be someone whom the regulators also seek out in terms of getting their opinion on how to develop bond markets. Even in cases such as the one which we are discussing now, which are a bit more niche in that sense, on SDIs or PTCs. The knowledge which rating agencies would have would be helpful for the regulators or the government officials to decide on the course of action in terms of how they want to develop those markets. So, and on a broader sense, rating agencies in terms of the rating actions which they come out with, the commentary which they give a sign or a signal as to how the overall economy is behaving. So let's say like in the last couple of years, the rating upgrades across rating agencies have typically outpaced the number of downgrades, which is a good sign, which is in the sense saying that India Inc. is in a relatively better position, at least in terms of the view of the rating agencies, in terms of servicing their debt. So that's the sort of role which rating agencies play. And within India, we have now 7 rating agencies carrying out that particular role.
Okay, yeah, that was a great description. Just to summarize, I think I can fairly say that it is an independent evaluator for creditworthiness of instruments, originators, issuers. I think plays a great role between the originator and the investors. And also something that I did not think of is being a thought leader to regulators as well, because the kind of expertise that you will build over time is unmatched. Um, so I'll turn to Ankit now. Ankit, so this is the view from Abhishek, like as as ICRA, as a credit rating agencies. Now we all know, and our audience knows that all GRIPS products are now rated. Every single one of our products is rated. What is GRIPS philosophy in your view? What is GRIPS philosophy to have these products rated? Why is it important for us to get these products rated?
Yeah. Thanks, Vaibhav. So, when GRIP is envisaging a product for a retail investor, our vision is to offer a product which investors can easily understand. And the two aspects of the product which an investor will want to understand more than anything else are the returns or the rewards the investment offers and the underlying risk behind it, right? While the metrics of return is easily, identifiable or the investor can consume it very easily, right? It's a 15% IRR or a 13% IRR, and it's comparable. However, the identifying the measure of risk is not so easy, right? And we thought that evaluation by an independent professional entity set up for this very purpose, playing a large role in the capital and the debt markets and to the economy as well, is the best agency to evaluate these products and assign a rating metrics to it, right? So, the core reason was very simply, Abhishek also alluded to it, for an investor, the measurement of rewards and the measurement of risk is very important. Rating a product assigns the measurement of risk to it. We also thought that, the institutional investors in the market today, requires a rating before they make an investment, predominantly, right? And we believed, why not offer the same metrics to the retail investors rather than any other metrics, right? So we wanted to bring this feature to the product, so that, besides GRIP's own credit assessment, there is another layer of validation, due diligence by a independent expert professional body, and that was the reason, the core philosophy why we felt all of our products should be rated, and that is how the scenario is today.
Yeah, and just also the benchmarking, right? Like, for example, GRIP will have its scores. GRIP can do a risk scoring, but now we have someone like ICRA whose benchmarking or whose scoring is well accepted in the market. So yeah, so thanks for that, Abhishek. I'll turn to you again, and this is probably the most important question of this webinar, or the question that I would be most curious to ask is what really goes on inside the functioning of a rating agency. For example, a product, or I mean, you can take an example of grip product as well, but any product in general comes to your desk. What are three, four, five things that you look at? How do you go through that evaluation? What are the key features there that you look at, secure in terms of security enhancement, underlying receivables, whatever it is? I think that will be really, really insightful.
Sure. So maybe let me take the LoanX product which Grip offers separately and the other products separately. Because LoanX essentially is more common to the typical loan receivable securitization that happens in the PTC market. So I'll limit my answer to this question to the securitization products, how we rate them, because when we rate corporates or financial entities, the processes would have some degree of variance. Right. So when we look at loan receivable securitization, where essentially the underlying receivables are coming from loans that have been disbursed typically by NBFCs, because they are the usual originators of such securitized products. What we first want to assess is the overall servicing ability of that entity, that NBFC in itself. Because in the Indian context, the originator is usually the servicer of the loans. So we assess the credit profile also of that servicer, which is the NBFC, and we also do a deeper dive into the servicing capability. We look at the past track record in terms of how the delinquencies have moved, what kind of vintages are there. We look at static data analysis. We look at dynamic delinquencies. Essentially, we try to figure out what kind of what kind of underwriting, first of all, they do, and what kind of collection capability they have in terms of getting the money from the borrowers. That sort of becomes the key starting point. Then our analysis is more towards the quality of the pool which is being securitized. So when I say pool, I am essentially talking about the bunching together of 1,000 or 10,000 contracts which are being securitized from the balance sheet of this NBFC. So usually the some of the filtering which has been carried out to cull out the pool of contracts for the securitization part, that sort of becomes important, because that helps in weeding out some of the contracts that may appear to be weaker. So typically in these securitized products, the quality of the pool is seen to be better than the overall quality of the NBFC's balance sheet because of the additional filtering which one does. And filtering could be in terms of identifying loans that have never been delinquent in the past, and some other conditions that can be laid out. So in our assessment, basis the quality of these pool of contracts, we then through our internal proprietary models, try to arrive at what kind of credit enhancement essentially would be needed in the structure to elevate it to a certain rating level. Right. So that sort of is the process followed in terms of rating a fresh transaction from the loan receivable securitization side. Now, the other products which are there, which are not so far typical in the Indian securitization market, be it invoice discounting or be it lease rental securitization. There, the process which is followed is understanding first the entity whose cash flows are being securitized. So unlike a loan receivable where we would have maybe 10,000 contracts in a pool, and it's not possible for us to look at each borrower independently, and one need not do that also because of the diversification that comes naturally in that pool. On the other hand, for let's say a lease rental securitization where there's only one lessee or two lessees, it becomes all the more important to look at the credit profile of those lessees. So we then do a separate assessment of those lessees, try to ascertain what kind of credit profile they have and their capability to pay that lease, which will again factor in their own financial strength. We carry out projections as to how their financials would behave in the future. And also we, in some cases, would have a track record of lease payments that also gives comfort. So once we have analyzed that, that becomes like a starting point for us to rate the instrument or the securitized instrument, which will then depend on what kind of structure has been proposed. These receivables essentially are bankruptcy remote. That becomes one of the very important parameters for rating any of these products. They are bankruptcy remote from the originator. So basis these points, we would then arrive at the rating of the final product. So yeah, the term sheet is something which we evaluate. And of course, we have done a few ratings for GRIP. We have those discussions with GRIP or any other originator or Inja in the market to ensure that the term sheet is watertight. And we always ask for a legal opinion on such structures to also get that clarified that the bankruptcy remoteness is being met.
Okay. Yeah, besides the credit evaluation of credit evaluation of the pools, receivables, lessees, if in case of leasex, I think Abhishek makes really interesting points on bankruptcy remoteness of the originator. I would please just hold your thought on that because I'd come back to this question. But before going there, Ankit, because we are talking about it, could you throw some light on our typical security features in our products? And maybe we can start with LoanX for certain examples.
Yeah, so Vaibhav, instead of talking about security features, I will maybe spend a couple of minutes on the structure of the instrument, right, which gives it a layer of security as well. We keep saying all our products are regulated, right? I just want to spend a couple of minutes on what value does it add for an investor to have a regulated product as an investment product, right? A regulator, India has two large regulators in the financial market. One is SEBI and one is RBI. Now, the role of the regulator is basically to protect the integrity of the financial markets and the products. When we say our products are regulated, we basically mean that the criteria set by these regulators are strictly adhered to in our products, right? And when the regulators' objective is to protect the integrity of the markets, the product is definitely better than it's a better product for the retail investor as well. Apart from the regulator, we have certain market participants who are vetting these products before we bring it to you. These are independent legal agents, for example, which Abhishek alluded to, or a SEBI registered trustee who will create a checks and balance process before we launch any such product on our platform, right? So this is important to understand, to appreciate the nature of the product and the kind of and the kind of security it brings to it. The second type of security package or security feature in our products is more explicit, and maybe we'll go to this slide, and if you look at security,
let's just take an example of our recent LoanX deal that we offered. This was done by Vedika, and our audience would know it as LoanX Vedika. And Ankit, go ahead.
So if you look at the security section here, there are three components which are the explicit nature of security present in this instrument. One is called as over collateralization. A 10% collateralization typically means that 110 rupee loans are securitized against 100 rupee of investment, right? So if the loan performs, the investors 100 rupees are protected, but more than that, there is a 10 rupee buffer over it, which can be used if some of the other loans are not performing in the pool, right? The second measure of security is cash collateral. This is basically, as the word suggests, this is a cash component which is contributed by the originator upfront. So this is as good as protecting 12% of your 100 rupee investment upfront itself, right? The third component is called excess interest spread. This is a spread between what the end borrower is paying as interest and what the originator is paying to the investor, right? Typically, there will be a gap between the two, which is also originator's margin, but this margin is assigned to the investors in this transaction. So, if needed, even this margin can be used to protect the investment of the investors. And there are certain numbers mentioned in each of these three security features, right? If you look at it, these are reasonably large number protecting your investment in different forms, but all of them contribute to making the investment, much secured. The third layer of inherent security in the product is diversification, as Abhishek mentioned. These are hundreds or thousands of underlying pools, right? For example, in this particular Vedika credit example, the number of borrowers are 4,000, right? So we have the comfort that your investment is distributed across a number of borrowers, so that if a few borrowers don't perform or are not able to pay on time, we have sufficient other borrowers who are able to perform, right? And the likelihood of default then reduces at the level of the instrument. So, to summarize, there are these three layers, so to say, of security features in our products. And, these are the specific examples which I wanted to give. But yeah.
Yeah. And I would just add to that. So if you see Vedika, and for the audience, Vedika is the NBFC who we address as originator in our conversation. So Vedika is the originator here. Now Vedika was rated as A minus. It's an A minus rated NBFC. However, because the security features that we spoke about and the diversification that Abhishek also mentioned earlier made the rating of this instrument a notch above as A. Abhishek, is it fair to say some of these, security enhancements make the instrument a notch above the originator?
Yeah, right, Vaibhav. So essentially, the credit enhancement which Ankit was talking about would help the entity for that particular pool reach a certain rating level. So if one is looking for a A rating, then this is the extent of credit enhancement which has been given. The rating ask could also be, if one wants to make it even more stronger, look at a A+ rating, then the credit enhancement would essentially go up. Right. So that is where the rating agencies play a role in terms of arriving at the right rating for the credit enhancement which is there.
Understood. Moving on from Grip's products, and as there's a larger audience present, just to make use of even more of your experience, could you tell us something around how has the securitization market performed over the years? What is the historical performance? Are there any trends on, downgrades or defaults on securitization market? And you can also address them as PTC's markets, whichever way you want. Yeah.
So, see, securitization in India is now close to 2 decades old. So some of the first set of securitization that happened was in the early 2000s. But the market really picked up sometime in 2018-19 when it sort of reached a new volume level. Other than COVID period where it was impacted, the numbers have continued to remain strong, and it's growing at a very good rate. So most of the market, 95-96%, would be coming from the loan receivable securitization, which in terms of GRIP's product profile, it's refers to LoanX, which Vaibhav was right now showing as an example. So that largely constitutes what has been securitized in the Indian market so far. In terms of the credit profile of these instruments, one would have to say that the overall track record over these past 2 decades has been very strong. The extent of downgrades, forget defaults, I'm talking even of downgrades of ratings, are very few in the securitization space in the Indian market. Defaults have been seen, but one would have very few instances of defaults that have happened to a senior PTC investor. The few defaults that have happened are being linked to some macroeconomic event such as demonetization. So during that period, some of the microfinance pools had seen defaults. And secondly, other examples of defaults would be more towards entity-specific events, where entity has undergone through either governance issues or some crisis because of which they are unable to carry out the servicing of the loans. But in these default instances also, the loss to the investor would not be nil, essentially, or rather not be 100% because of the way this product works, where every month there would be some collections that you keep getting back. Then there is a credit enhancement that Ankit was talking about, which supports to some extent of pool loan level defaults. Also, the investor gets protected. So the loss post default have also been largely limited. So that's been the story so far of securitization. And in that sense, it has been one of the safer products, but it's largely been on the loan receivable securitization. On the other kind of products, it would again, one would have to see a history build in terms of the newer products. But they are maybe a bit more specific and case-to-case evaluation has to be done. It would be difficult to bunch them up together and say that this is one kind of a market. Like for example, the lease receivable securitization, the difference in the credit profile of the lessee could vary the ratings a lot and essentially the risk profile of that securitized product. So one could have a double B kind of lessee whose lease receivables are being securitized versus a category lessee. So accordingly, the ratings would also reflect that difference in risk, and the default probabilities would also be different. So how this particular market scales up, which is in the non-financial institution space, non-NBFC space, how this market comes up, what kind of PTCs find enough investors at what rating levels. We'll have to gather more data on that to eventually see how the defaults in this space move.
Yeah, great. I think still good to hear that overall the performance of the PTCs and securitization market has been so good, except for maybe some black swan events or such. Okay, just extending that question a little bit, because you said that loan receivables is kind of a mature industry in India. By the numbers that I remember is that the loan receivable securitization is already a $20 billion industry in India. But most of it, and for 2 decades or maybe less, as you said, they have been accessible only to the institutional investors. It was never, or maybe like is never the right word. It was probably never brought to the individual investors, which GRIP is doing right now with in loan receivables with LoanX product, lease receivables, LeaseX product, and so on and so forth. What are your views on bringing these opportunities to individual investors from what institutional investors have very massively participated in already for a long periods of time?
Right. So just to throw in some numbers, Vaibhav, maybe more in INR terms, the securitization market just prior to pandemic had reached levels close to 2 trillion rupees. And at the current moment, it is again back at similar kind of levels. During COVID period, of course, loan disbursements was itself impacted. So securitization was also impacted in terms of volumes. But the market is growing again on a strong rate year-on-year basis. And the typical investors in these markets have always been institutions, largely banks, private sector banks, foreign banks, public sector banks. They have had different reasons, of course, to participate in this. But one of the reasons for the growth in the market has also been the strong performance of the pools throughout the journey so far. And that is what I was talking about in my response to your previous question. So the limited defaults that have happened, the nature of the product where the credit profile or improves with time, because the credit enhancement which is there at the initial period, as the loan amortizes, the credit enhancement for the balance remaining pool would keep on going up. So typically we see more upgrades happen in this product vis-a-vis downgrades by a great margin. So from that perspective, having seen this industry so far, it's interesting to see now this product getting offered to the retail investors and allowing them also a chance to participate in the growth which is happening in this particular market. What it allows in terms for the retail investors is, of course, offering them a different or a wider range of risks versus rewards. So just like the example which you were showing of Vedika, where the rating assigned to that entity is A minus. But when they carry out securitization, depending on the extent of credit enhancement, they could sort of look for a A rating or a A plus rating or possibly even higher. Right. So an entity which is rated at a certain level can have a securitized product which is rated a few notches higher, depending on how much credit enhancement they are willing to keep. So that essentially improves the availability of instruments at different rating levels, which will of course carry different, let's say, interest rates, which gives a wider option to investors to select what kind of riskiness they see in that product versus the interest which is being offered. So that variety is more available in securitized products, especially on that low next kind of product, vis-a-vis the typical bonds that would be more taking assessment on the balance sheet of the entity.
So I think you have already answered this, but this is one of the questions that I get very frequently. And if you would want to add here something, what is the difference between investing in a corporate bond of an NBFC versus investing in PTCs issued by the same NBFCs? So, and this has happened, right? Vedika,
Yep.
There are corporate bonds available. The last deal was Lonex Kirtana. There were Kirtana bonds available. So how should investors look at risk reward in case of a Lonex Kirtana that GRIP issues, a GRIP provides access to, versus a Kirtana corporate bond?
So let's understand what risk one is investing in. When you're investing in the bond of the entity, you're essentially taking a call on the balance sheet of the entity. The capability of the entity to pay out those bond installments in the next 2 to 3 years, whatever is the tenure of the bond. That is the call which an investor is taking. And as per assessment of a rating agency, let's say that entity is rated BBB. So that is the default probability on the entity's bonds as well. vis-a-vis that same triple B entity assigning a PTC. The PTC here, essentially, you are taking a call on the collections that will come from the underlying borrowers. And of course, you have to factor in the servicing ability of that NBFC to collect money from those borrowers and pay to the PTC holders. So here there is no balance sheet support which will come from the NBFC. But depending on the quality of the borrowers, depending on the capability of the servicer to collect from the borrowers, and the credit enhancement features which are available, the risk of that is quite different than the risk which one is taking when investing on the bond. Now, again, coming back to the rating which gets assigned, of course, being from a rating agency, for me, that plays an important sort of metrics to decide which is risky or not. The triple B rated NBFC, if it has issued a PTC which is rated higher, then because of these credit enhancement features, what the rating agency is at least trying to say is that the safety features are better. The default probability on that PTC is going to be lower than the bond. So, see, rating is one way to sort of arrive at the differentiation, but then of course an investor can do their independent evaluation. But what one is investing in is very different, and that one has to sort of be clear on. There have been some examples in the securitization history of India, wherein some large housing finance companies which underwent through difficult period, they defaulted on the bonds which had been issued by them. They eventually got resolved, but the bondholder gets some cents against the dollar. So you have lost some money against the bond issuances. Whereas the same HFCs, they had PTCs also which were outstanding. But PTCs, again, being bankruptcy remote, the collections on those pool of borrowers was still good. The PTC holders did not lose any money. But having said that, these are examples which one has seen in the housing finance market. There have been a few examples which have gone the other way as well, especially during the demonetization period. So the risk essentially which is being carried is different, and depending how, of course, what are the reasons that will impact the entity for it to default on a bond could be very different than the reasons that could lead to a default on the PTC. I hope Vaibhav have answered your question.
Yeah, in great detail. I would. There are some of the points that you mentioned are something I would like to note down on my pad. But okay, moving on. There's one question. I think we have used this word a couple of times now. The bankruptcy remoteness of originator. So Mayank is asking, what is bankruptcy remoteness? If you or Ankit, if you want to take that.
I can take that. Yeah. So bankruptcy remoteness, when we say, what we are talking of, if let's say an NBFC would have 1 lakh loans which they have issued on the balance sheet. They have taken out 10,000 loans and securitized it and sold it through this product. Then in the event that the NBFC was to become bankrupt and go through a bankruptcy proceeding, none of the creditors of the NBFC should have a claim on those 10,000 loans which have been securitized. So the collections that keep on continue to come from those 10,000 contracts would be paid to the PTC holders even during the process of bankruptcy resolution that the NBFC is into. So this was the example which earlier also I was saying, where one of the large housing finance companies was undergoing a bankruptcy resolution process under the IBC framework. And that went on for a year. But during that year, the collections which were coming from contracts that had been securitized, they were getting passed to the trust, and the trustee was essentially then passing it on to the PTC holders with no, let's say, no haircut which was being taken on those collections. So that bankruptcy remoteness from the originator becomes a very important point for a rating agency to give a higher rating than the entity's own balance sheet rating.
Got it. Understood. I also have my eyes on the clock, so we will move to the Q&A for the audience. But just one last question, Abhishek. So a product is structured, it comes to ICRA, ICRA has rated the product, investors have invested in that product. Is there any role that ICRA plays post the rating and issuance of the instrument during the tenure of the instrument?
Yeah. So once a rating has been assigned and it has been accepted by the originator, we issue a rating rationale on our website as well. And then as per regulations, we need to continuously monitor the performance of the instrument. So at any instance where we feel that the instrument's performance has weakened, or otherwise as well, we need to then take appropriate rating actions and disclose them through our website. Mandatorily, we have to issue one rating action in 12-month period. So the rating may be either reaffirmed, which means it remains at the same level, or it gets downgraded or upgraded. So that is a SEBI requirement. But even otherwise, we need to continuously monitor so that we disseminate information quickly to the market whenever there is an adverse movement or even when things are going well.
Okay, so there is an important role to play even during the tenure of the instrument. Let me quickly jump on to the Q&A from the audience. So first question I'll take from Gopal is, what can you please clarify the hierarchy of ratings? Because, even among the rating agencies, they use different terminology. There are, different alphabets, different plus or minus notches that they use. How do investors get a hang of that?
No, so there is no difference on the rating scale across rating agencies in India. India is one of the countries where the regulator has clearly defined what rating scale is to be used. And all rating agencies follow the same scale. In fact, what rating agencies have been asked to do is attach their name as a prefix to the rating. So when ICRA gives a rating, let's say the rating is A, it will be ICRA A. And if it's XYZ rating agency, it will be XYZ A. So that the investor knows through the rating itself what rating has been, which is the rating agency that is given the rating. The plus and minus symbols are used again by all rating agencies as per the framework laid out by SEBI. And just to clarify, a rating, let's say A rating, A plus is better than A minus is weaker than A. So every rating level has 3 ratings. Within A category, the probability of default is lowest for A plus, then A minus. Only AAA rating, which is the best rating, that has no plus and minus, and default rating, which is D, that has no plus and minus. Otherwise, every other rating category will have 3 ratings plus no symbol and minus.
Understood. Similar kind of lines, but Kalpesh has asked, can you brief on the percentages of default vis-a-vis ratings given? Like what's the percentage of default in AAA, AA, so on and so forth. I don't think we can go into like exact default on this webinar, but do you want to like maybe like just qualitatively answer this?
Yeah. So every rating agency is again required to publish their default rates. This is again a regulatory requirement. So all rating agencies are regulated both by SEBI and RBI. It's a very strongly regulated industry. And if you want to find out those default rates, you can go to any rating agency's website and might have to search for a bit, but you will find their default rates. There are 3-year default rates, 1-year default rate, which will tell you for that rating agency what has been the defaults from a particular rating category in the past 1 year or past 3 years. Right. So it's a good matrix for you also to use if you want to differentiate between the quality of the rating agencies. As I said, there are 7 rating agencies, but the default rates would have been different. So that's something for the investors to look at individual rating agencies' website.
Oh, okay. There's a related question on the chat box that there are a few rating agencies, 7 to be precise. How is ICRA different, and how is ICRA different? I think you just briefly answered that question.
Yeah. I don't want to pitch for ICRA here, but ICRA is that way one of the oldest rating agencies, again, where Moody's, which is globally the largest rating agency, is our parent. And our default matrix, which I was just referring to, speaks for itself. We are committed in terms of ensuring that the investors are informed in a timely manner in terms of credit profiles of the entities. So, yeah.
Ankit, question for you. Are rating rationales public documents? Can anyone
I've already responded, but yes, as a mandatory requirement by the regulator, each rating agency must publish the rating rationale on their website. As I said, it's a mandatory requirement. So please feel free to visit any of the rating agencies' website, and you will find all their evaluation published on the website. The rationale is also a detailed document describing how they arrived at that particular rating for a product. So, I personally feel that it's very important for investors to go through that couple of 2-3 pages of rationale to understand the underlying transaction or the product before investing.
Kalpesh, can you summarize 10 important pointers which rating agency looks into before rating a company or securitized debt? I don't think I can summarize it right now, but if you revisit this webinar, you would definitely have those 10 important pointers that a rating agency looks for. Gopal, any deal of InvoiceX on the platform currently? Unfortunately, no, but stay tuned. We will bring something soon. Ankit, if I have invested in a GRIP instrument, will my data be available publicly because the product is listed?
The straight answer is no. Investor data is not publicly available just because the instrument is listed on the debt exchange of either NSE or BSE. We're not supposed to give out the investor data in the public domain.
I would just say that the data on the instrument is public, and that gives even more visibility on the instrument besides tradability, liquidity, but no for investor data. Will you be sharing the recording with? Yeah, this webinar recording will be shared with all the registered participants. Okay, this one is a good question, Abhishek. Sandeep is asking, how do rating agencies get the information about the rated companies independently? But let's just say companies or originators independently, or does it solely and completely rely on the information provided by company or GRIP or whatever?
Okay. So see, one of the important information requirements would always be the audited annual reports, which has been, of course, then independently verified by the auditor. The other independent check which we do is in terms of speaking to the bankers of the company. So there one gets a sense as to the comfort which the bankers have on that entity, and that sort of goes in our assessment. We do rely on the information shared by the entity, but that of course then has to match up with what the financial statements say. And our own channel checks in terms of the industry which the company is into. So typically, we would have a good coverage across all industries, and we would have a sense of how the industry is performing, how the entities are performing. We would hear market news essentially, which would help in corroborating whatever the information is being shared by the entity.
Understood. Is there a product note on LeaseX, InvoiceX, LoanX so that I can get a snapshot? All information is available on our website for all deals. You can go the structure of the instrument, the underlying originators, the lease receivables, everything, the receivable profile, everything is provided on the website. There are some questions around NCD and PTCs. I think Abhishek spoke about them in great detail. I would just urge you to go back to this webinar once we share the recording, and I think most of these questions will be very, very clear. Pushkraj has asked a question. Any of you can take this because I'm not able to understand this question clearly, but how do bonds stand out from mutual funds, and what returns are good returns in bonds?
Yeah, let me take it briefly. I think Pushkaraj, I think bond and a mutual fund. Again, you're not specified what mutual fund you're referring to. Are you referring to a equity mutual fund or an index mutual fund or a bond mutual fund? But I think these are really very different instruments, and I think it'll require a sufficient bit of time to explain this. If you can leave your email ID, we can maybe come back to you and share some broad materials or understanding around these two products.
Yeah, just add, please reach out to your dedicated relationship manager and we'd be happy to help out on that. Okay, we are already beyond the clock. So just last question, because Gopal had asked, why are there two rating agencies in one company? It is confusing. Let me start and then you guys can add. So Gopal, there is an originator and there is an originator rating and there is an instrument rating. And we discussed some of these things, right? Like how originators are rated and how the instruments that GRIP is bringing to you, the SDI instruments, how are they rated? And that's why there could be two rating agencies and different rating for the originator and the instrument. Anything either of you would like to add to that?
Yeah, I mean, and conceptually, a company is free to get their product rated by multiple rating agencies, right? So as Abhishek mentioned, there are 7 rating agencies in India. There is no regulation which prohibits a particular issuer or borrower or a company to go to multiple rating agencies and get a view on their credit, on their underlying credit. I mean, this view may, by the way, also differ from a rating agency to rating agency, because ultimately it's a assessment which could vary from one expert to another. But suffice to say that all these 7 rating agencies are very much regulated by SEBI. So there are criteria laid out in great detail about the rating processes. So I believe everyone's view is an expert view. Abhishek, if you want to add.
Yeah, no, correct. So essentially, an entity can get rated by any number of rating agencies. It is a mandate which is given by the entity itself, and there are multiple examples of entities having dual ratings, if not ratings from 3 agencies. As an investor, I think what I would also urge is ratings should act like maybe a starting point, or they should be one of the inputs that you have in your investment making decisions. In addition to that, one has to, of course, then have their independent evaluation of the entity or the product in which one is investing.
All right. Thank you so much. Thank you, audience, for joining in on this Saturday afternoon. Thank you, Abhishek, for spending this time with us, and also for really insightful explanations on some of these things. Thank you, and have a good weekend.
Thank you, Vaibhav. Thank you, Ankit. My pleasure.
Thank you.
Thank you. Bye.
Bye.
Investments in debt securities are subject to risk. Read all the offer related documents carefully.